Joining us now, Kevin Geddes, president of Fixed Income Capital Markets at Raymond James, and Ryan Payne, president of Payne Capital Management, our guest host for the hour, Tobias Lefkovich, chief U.S. equity strategist at Citi. Gentlemen, good morning to you all. Kevin, I'll start it off with you, since this has really been a fixed income story for the large part. You say we're going to test the prior low on the 10-year yield. There are all sorts of firms out there, institutions, PIMCO saying zero, Bank of America, Merrill Lynch saying sub 1% is a possibility, JP Morgan saying that the environment right now is like quicksand for the U.S. Treasury market as well. Where do you see us ultimately going?
Well, somewhere in between there. I will tell you that about mid-morning yesterday, I had this vision of 2008 coming back to me when we were in a basic free fall. It was great to see that consolidation and a rebound in the afternoon, even as a bond guy. This is one of those rare opportunities where we're actually wagging the dog, so to speak. So I do think that the Fed is behind the curve again, and that they would have to be aggressive in September, if not before. I wouldn't rule out the chance that the Fed could go in a meeting, a pre-meeting type of ease if we saw another day like yesterday. But if we see some stability, then I am fine with where we are. We probably will take out the 2016 low at 135 on 10s. And the curve, the way it's flattening, would indicate that the Fed needs to get moving pretty soon.
I don't want to be a Fed defender in any way or a Fed basher, but how do they get ahead of the curve at this point when every single central bank has either eased already or is telegraphed, such as the ECB, telegraphed an ease to come in September?
Yeah, you know, that was the surprise of yesterday with India and New Zealand in particular. I don't think uncertainty is not your friend most times. It really wasn't yesterday, and I think that that set off the bond market. If we could see some stability, then the Fed is probably where they need to be. But at this point, where the race to the bottom is occurring and the Fed is a little bit behind that, the market is dictating the next terms, and I think that's something that they can possibly wait till September. We need to see some stability like yesterday afternoon.
So yesterday morning, the free fall in Treasury yields that we were witnessing right here on air, it felt like 2008 times. But the equity markets, I mean, it followed, but ultimately we closed about 5% off of the July record highs on the S&P 500. We're really not far away from full valuations here.
Yeah, I mean, at full valuations, I mean, it's 18 times forward earnings. I think the thing that scares me is all that money being jammed into bond funds right now. You have like $255 billion. And let's just, God forbid, you know, something eases off with trade. We get global growth picking up a little bit the second half of the year. That means interest rates go up. That means that the 10-year goes up, and means those bond funds are just going to get hammered. So I think, to me, that's the real risk. I think the equity markets are just a, bona fide deal here versus what you're seeing in the fixed income
So you
markets.
think we'll actually see a spike in yields to the point where it's going to cause some sort of tumult in the markets?
I mean, it only has to be a tiny one, and you're going to see the bond market like implode. Would be my best estimation of that.